Okay, let's connect then with Anand Tandon as well, who's joining in on the show to share with us his fundamental outlook. Hi there, Anand. Good to have you on board. What's the outlook on the index after scaling those life highs? When we do you believe that we're likely to hover around those levels? What would be your outlook in terms of the next key triggers for the market?
Well, the first thing one is looking for is obviously the view on interest rate, and right now the consensus is that we are in for an extended pause. If that were to, that would be enough for the market to be propelled to a new high for the moment. That said, it's not as if the markets are extremely cheap, so the overall upside can still be not very far from where we are. For the near term, from a trader's perspective, obviously that means you stay long and not try and outguess where the market will end, because the market can probably become even more expensive from where it is. Currently, it is not very expensive. It is just about marginally at long-term valuations average. And assuming the earnings hold up, the forward is 1 year forward earnings are also, the estimates are indicating that the market is trading at around 18 times or whatever, which is not particularly expensive. So for the moment, fundamentally, I would argue that one should still be biased on the long side. But as it goes up, obviously, you want to increase a little bit of caution.
There you have it. That's the outlook coming in on the markets as a whole. But let's also get in a sense as to what your view is when it comes to the entire new age tech space. For instance, today PB FinTech has got a report from brokerage BofA, and they believe that the growth rate will slow down and the cutback in ad spends is going to be a bit of a risk to growth. Recently, there was an upgrade coming in on Nykaa as well. How are you looking at the entire space?
Well, they are still looking quite expensive to me. There is a conundrum there. Those, if you want to show profits, you have to stop the kind of mad rush for client acquisition that many of these companies have been going through. And if you were to do that, then the case for having a very high valuation becomes even less, because slow growing company is not what you're betting for when you have the kind of valuations that these are trading at. So really, you have to take a call on whether or not you will be able to grow at least significantly high clip, despite cutting back on the spend that one is doing in terms of the acquisition. That said, you do have to remember that the tech companies have one advantage, which is, or disadvantage, depending on how you look at it, that the accounting systems do not consider client acquisition and the brand spend, for example, or even the tech investments as capitalizable assets. And because of that, while the accounting prefers companies which have hard assets, the earnings growth for many, the earnings potential for, and the universe for many of these new age tech companies is far, far bigger. And therefore, it makes sense for them to be spending money. So I think they have to maintain a balance between making sure that there is enough earnings for the market to remain interested, at the same time delivering above significantly high, top range kind of growth for you to be able to justify the valuation. I think it's a tough ask. Some more time should elapse before you will be able to really make a view on which one of them are really going to do extremely well and which justify the earnings and the valuation that they are at.
Anand, what is the best way to approach the telecom space, which has just such few options, right? I mean, you've only got a Bharti and a Jio here.
There is no reason why you should not be buying a Bharti or a Jio. I mean, at the end of the day, those are the market leaders and will likely remain. Vodafone is way behind in terms of investing in capacity, in terms of 5G, etc. They are going to continue to lose market share for the foreseeable future. I don't see BSNL making a material difference. So, from a core telecom perspective, I think the standalone Bharti is probably still remains, the best way of playing the sector. Reliance hasn't moved too much over the last few quarters, so that can also be a place where some surprises are possible, because over that time frame, the retail business has done exceedingly well. They have grown quite considerably. The refining is obviously continues to do well and is likely to report decent numbers. I don't see any of the sectors that Reliance is operating in being under any serious pressure.
Okay, meantime, I wanted to get in your take, Anand, as to what you make of the entire auto space, talking about new launches as well coming in from the likes of Hero Moto, EV plans, ambitious plans from a lot of these auto companies. Which are some of the stocks that you like within this sector?
Well, Hero Motor could be a surprise because they have been one of the laggards losing market share consistently, but they seem to be now indicating that they have a whole new set of launches. Uh, the only risk is that the launches may fail as many of their earlier launches have, but considering that their pipeline right now looks robust, and the valuation at which they are trading is extremely attractive. I think they are close to 4% dividend yield for a company which has been around for such a long time. Also, the market at which the end of which they so far have been traditionally servicing, which is the lower end of the motorcycle curve, that I think the rural markets will do well in the second half of the year, and therefore I would argue that Hero Motors seems to be in a space which is both attractive from a potential growth point of view as well as the current valuation expectations. For the rest, I think the street is very bullish on Tata Motors. Mahindras, I think, have become slightly expensive, but otherwise that remains a area to be looking at. Basically, I would prefer looking at Mahindras because of the fact that, as I mentioned, I'm more bullish on what is likely to happen in the rural parts of India going forward. So that's broadly the space. For the most of the others, I think pure play EV is a little difficult to play because there are lots of players which are entering, and it's a completely new market. So it's very likely that you will have new leaders coming through, not necessarily the established ones.
Interesting. To that exclusive news that my colleague was just highlighting on OMCs, given the amount of strict regulations here and the sensitivity to oil prices, would you skip the sector altogether from an investment perspective?
Well, if the government keeps on coming out with regulation and trying to indicate where the prices should be, it has always been a problem in terms of valuing these companies on a longer term basis. For the moment, one had assumed that they would let them kind of move the prices around. And I'm surprised to hear about the fact that there is a assumption that there is a drop in prices. I mean, I see crude going up actually from here for the rest of the year, perhaps. So the kind of numbers that the companies are reporting, uh, you had last year was a good year where GRMs did well, marketing margins were not that great, and of course this is an assumption because they have stopped reporting separate numbers. But going forward, if you had that kind of flexibility, you would have thought that they would be able to recover for significant amount, make significant amounts of money. If that gets capped, then I think it becomes a little more difficult to value them. Right now, they are good on the dividend yield, so they may be attractive from that perspective. But certainly, the growth numbers become a little more suspect.
Also wanted to understand from you what the outlook is when it comes to the entire hospitality sector. With renewed vigor, now we are seeing demand having picked up like never before. Rates as well have gone through the roof, and more importantly, a lot of the managements as well that we've been speaking to within the hospitality space are very confident about this demand continuing to sustain. What is it that you would like within the entire sector?
Well, this sector obviously is doing very well. There is no question. You can see both the ARR, the occupancy, and the room rents are much higher than they have been in the recent several years now because of COVID and after. So the delta obviously is in favor of these companies. However, you have to remember that these typically are fairly capital intensive projects. And even a company like Indian Hotels, for example, has now put up a whole new segment where they are looking at uh, franchising out and taking over properties on a management contract basis rather than putting up money. So that's a model that works reasonably well, provided somebody else is willing to put up the capital. So it becomes more a services business than an asset owning business, which means that companies like Indian Hotels and some of the newer companies may actually be a little better positioned than, for example, an EIH or even an ITC group hotel business where they tend to own more of their properties. That said, I think this will remain a cyclical business. Near term, of course, the cycle is on the upside. So for the near term, I don't think that there is any issue in terms of owning these stocks. But you have to be careful about when the cycle turns because it will turn without warning. It's not as if the managements have perfect vision in terms of being able to forecast.
The other stocks which are going to be in focus. Yesterday, of course, there was Tata Consumer, Britannia, Nestle. These were all the names which are spiking up. Of course, the palm oil and other RMC costs easing off is definitely aiding some move on these names. But before that, let's just mark what the Nifty pre-open rates are indicating. And I think we should give some time for these rates to settle down, because while the SGX Nifty was indicating a quiet start, right now these rates are all over the place. Though 18,700 is the print that you're seeing on the Nifty pre-open rates, and that's quite okay, because practically we were pretty much there on closing yesterday as well. Mildly tempered up in the green for the Sensex, which is currently at 63,250 odd levels. But Anand, this fresh renewed vigor, which was already a very buoyant space, FMCG, Britannia, Nestle, the entire pack holding out. And even if you look at the earnings, I don't think beyond Dabur there was any stark disappointment, so to speak.
Well, yes, I think this was a case that one made last year, that with the inflation peaking, with the inflation going up, strong brands will be able to pass that on and therefore will do well, despite the fact that the raw material prices were up. The raw material prices now are down, and the prices at the retail end have moved up. So consequently, you would expect to see a margin expansion coming through. Volume growth may be a little more suspect this year, in my view, except for those again which are rural facing. So you may expect to see companies like Dabur actually do better. But overall, I think the consumer space has been reasonably buoyant, and I would expect to see some margin expansion in the current year, which means that the earnings will sustain. Overall, however, this is a very expensive space for the simple reason that you have companies which are still trading in the teens. I mean, where the earnings growth are in the teens by and large, and they're trading at 50, 60 times forward earnings. So you have to be a little careful about the segment you want to choose if you are not going to be surprised. That said, as I mentioned, overall the market direction is up, so therefore you would expect to see the consumer business, especially FMCG, do reasonably well for this year.
Likely to do reasonably well for this year. In the meantime, also wanted to understand, Anand, what the outlook is when it comes to some of the pharmaceutical names. Just today as well, there were some interesting notes that came out with respect to Fortis Healthcare, etc. Would you be very selective, largely owing to expensive valuations when it comes to the pharma space?
So I think if you're looking at healthcare, you have to break it up into the pharma and the hospitals. I think the smaller hospitals or the companies like Aster and NH, etc., have done exceedingly well over the last few years, as has Apollo, but Apollo is a little more expensive at this stage, perhaps. I would expect that that continues, because the overall trend in that segment of the market is going to be more corporatization, smaller companies getting acquired, perhaps single standalone hospitals merging into chains, and so on. So that kind of consolidation will actually favor the listed players, especially the larger ones. Uh, the valuations, no doubt, are a bit of an issue, but I think you have enough levers to be able to raise earnings whenever, at various points of time. So it's not like, they are overly priced compared to what earnings growth is possible. When you're looking at pharma, that's been a slightly depressed pace, I think largely because the API business has not done well. I think in the US, that is beginning to turn around now, and I would imagine that that should enable many companies who were somewhat under pressure over the last 24 months to actually do reasonably well. So in that sense, more than domestic pharma, which has been a consistent performer, I would expect the delta to come from companies selling APIs and generics in the US market and the developed market. And I think there are several of those which are listed which should do well.
Okay, Anand, stay with us.
They go higher. Corporate banks do well. They get benefits because of NIMs. But when interest rates they start peaking out and if economy is strong, NBFCs they start outperforming. Are we going to go through that phase?
Is that for me?
That's right, Anand.
Yes, absolutely. I would imagine so. There is no, they are wholesale borrowers, and therefore, obviously, in an interest rate up cycle, since they don't have the ability to raise liabilities, that becomes a problem. You are borrowing from banks. Once the banks find that they are not able to raise interest rates further, obviously, NBFCs, which are lending to a slightly more riskier set of clients and with perhaps less security, etc., are able to charge higher interest rates. So their margins are likely to expand. So for now, I would imagine that's the phase we are in. Assuming that there is no change in RBI stance, you would have interest rates frozen for a while, and that will mean that the asset book that the NBFCs put up will be able to give them a margin which is perhaps disproportionate to what the earnings, what the banks are probably able to raise at this stage.
Very much, Anand. Good to have you on board with your take on the markets. Let's tell you what the index